All right, today we're building a playbook. We're going to dive deep into the world of precious metals to answer a really critical question for any investor. How do you get the rock-solid stability of gold, but also capture the absolutely explosive potential of silver? We're going to show you how to blend mining stocks to build a portfolio that really does try to get the best of both worlds, safety and serious growth.
So here's the game plan. First up, we'll get to know our two main characters, gold and silver. Then, we're going to break down exactly what makes gold the anchor of a portfolio and why silver is the industrial engine. After that, we get practical. We'll talk about how to invest and then build the actual blending strategy. And we'll wrap it all up by looking to the future and weighing the forces that could totally define the next decade for these metals.
Okay, let's jump right in. Look, before you can build any strategy, you have to know your players. And in our story, that's gold and silver. You know, on Wall Street, they've got this great nickname for them, King Gold and its crazy cousin, silver. And honestly, that pretty much nails their relationship. One gives you that steady, regal stability, while the other brings this wild, unpredictable, and exciting energy.
And this right here is the heart of our entire playbook. You've got two totally different jobs. Gold is your anchor. It's the classic safe haven, right? The thing you want in your portfolio when the markets get choppy and inflation starts to bite. But then you've got silver, and that's the engine. It's what we call a high beta metal, which just means its price swings a lot more dramatically. And that volatility, plus its dual personality as both money and a critical industrial metal, well, that's where the massive growth potential comes from.
So let's lay the foundation here. Before we can even think about blending, we need to really get a handle on the bedrock of this whole strategy, gold. I mean, there's a reason people have flocked to it for literally centuries, right? Through the rise and fall of empires. It's because gold is, without a doubt, the ultimate safe haven asset. Yeah, and when you look at these roles, you see why it's seen as a shield. Each one of these points just reinforces the others. You know, when governments are printing tons of money and inflation is creeping up, gold tends to hold its value. When there's geopolitical chaos, it's like a form of financial insurance. This is exactly what investors mean when they say it's a risk-off asset. When fear is high, the money flows into gold, which helps stabilize your portfolio when other things might be dropping. It's the very definition of a store of value.
Okay, so now let's flip over to the other, more volatile side of our playbook, silver. You know, for decades, it kind of got dismissed as just poor man's gold. But that label is so incredibly outdated now. It completely misses the powerful, modern story that's unfolding as we speak. To really get its potential, you have to unpack its very unique dual identity.
And here it is. This is what makes silver so fascinating. Its value is basically a tug-of-war between two very powerful, very different forces. On one hand, yeah, it has its monetary role where it kind of acts like gold's little brother as a store of value. But on the other hand, you have something that gold just doesn't have. It's an absolutely essential, non-negotiable industrial commodity. And that industrial side, that is where the story gets really, really interesting for the future.
And when I say industrial demand, I mean it is absolutely exploding. We're not talking about forks and knives anymore. Today's demand for silver is being driven by the biggest technological revolutions of our lifetime. Silver is a must-have component in every single solar panel and every electric vehicle. It's literally built into the infrastructure of the AI revolution, from data centers to high-speed computing. It's also critical for 5G and for advanced defense tech. This is not some speculative, maybe demand. It's non-negotiable if we want to build the future.
So this brings us to a fundamental problem of Economics 101. This massive, surging demand has run headfirst into a very tight supply. To put it simply, we are using way more silver than we're pulling out of the ground. The Silver Institute is projecting that the world is going to face a 67 million ounce deficit in 2026. And get this isn't a fluke. It would be the 6th consecutive year of a global silver deficit. That kind of structural imbalance creates an incredibly strong tailwind for the price of the metal.
Okay, so we've established the why you'd want to own gold and silver. Now let's switch gears to the how. How do you actually get them into your portfolio? The good news is you've got a few different options, ranging from the classic old-school way of just holding the physical metal, all the way to a more modern strategy of using the stock market to make a leveraged bet.
Right, so the most direct way is just buying physical bullion, coins and bars. You own it, it's yours. But that comes with having to store it and paying premiums over the spot price. A much easier option for most people is a physically backed ETF, like the iShares Silver Trust, ticker SLV. It's super liquid, trades just like a stock, and every share represents a little piece of real silver sitting in a vault. But for our playbook today, we are zeroing in on that third option, mining stocks. And the reason comes down to one incredibly powerful word: leverage.
Now, to understand this idea of leverage, you have to get familiar with one little acronym, AISC. It stands for all-in sustaining cost. Just think of this as the true break-even price for a mining company. It's not just the cost of digging metal out of the ground. No, it includes everything: salaries, exploration to find new deposits, fixing equipment, basically everything it takes to keep the lights on and pull 1 single ounce of metal out of the earth. This number is the absolute key to everything we're about to talk about.
And right here, this is where the magic happens. A miner's costs, their AISC, are pretty much fixed. So let's just walk through a quick example. Let's say you have a silver miner, and their AISC is $25 an ounce. If silver is trading at $30, their profit is $5 an ounce. Easy, right? But now, let's say a bull market hits, and the price of silver doubles to $60. The price of silver went up 100%, but look what happens to the miner. Their cost is still around $25, but now their profit per ounce is $35. So their profit didn't just double, it went up 600%. A 100% move in the metal created a 600% explosion in their profit margin. That is the incredible power of operational leverage.
Okay, time to bring all these pieces together. We've got our anchor asset, gold, we have our growth engine, silver, and we have our supercharged vehicle, mining stocks. Now it's time to actually build the strategy and show you how to blend these different miners to get that balance between stability and growth.
So inside the mining world, you can basically split companies into two big groups. First, you have the senior miners. These are the giants, the big established producers. Think of them like the blue chip stocks of the mining world, usually lower risk, often focused on gold. And then you have the junior miners. These are the smaller, scrappier companies. They're often still exploring or developing a mine, so they're way higher risk, but they also have the potential for much, much higher rewards. And this is where you often find the pure play bets on silver.
This table is awesome because it shows how we can use these different types of companies like building blocks, right? Each one has a specific job to do. You might use a gold major like Agnico Eagle to give you that low-risk stability. Then, for that aggressive growth, you could add a pure-play silver producer like Hecla Mining. For a different flavor of low risk, a streaming company like Wheaton Precious Metals can provide great cash flow. And if you want to play in that high-risk, high-reward junior space without betting on just one company, you can use an ETF like SILJ, which holds a whole basket of them.
So this all leads us to the actual portfolio structure, which is a classic strategy called core and satellite. It's really simple. Your core, that's your foundation. That's where you put your stable, low-risk, gold-focused miners. They're your defense. Then, orbiting that core, you add your satellite positions. These are your smaller, more strategic bets on those high-beta, silver-focused miners. These guys are your offense, where you go for that aggressive growth potential. And a really smart way to build out that satellite part is with an ETF like SILJ, because it spreads your risk across a whole bunch of these smaller companies at once.
So, we've built the playbook, we have our strategy, but, no strategy exists in a bubble. We have to look ahead and think about the huge forces that could shape this market. So, what's going to be the bigger story in the next decade? Is it going to be monetary pressure pushing people into safe havens, or will it be that unstoppable industrial demand from all this new tech?
This chart shows you exactly what we mean by high beta. When you get a really strong bull market in precious metals, this is the kind of thing you often see. In this example, gold had a fantastic run, right? But silver, with its higher volatility, just left it in the dust. It dramatically outperformed. That is silver's high beta nature in action. When things are good, silver can feel like gold on steroids. But, and this is so important to remember, that sword cuts both ways. That outperformance comes with a lot more risk if the market turns down.
And some really smart market analysts are looking at all these dynamics and making some incredibly bullish calls. Macro strategist David Hunter, for instance, has put out these pretty eye-popping targets, $180 for silver and $6,800 for gold. And what's wild is that he's not talking about 10 years from now. His whole thesis is that a perfect storm of monetary factors like debt and inflation, plus that non-negotiable industrial demand, could create a truly parabolic move in the very near future.
And that really brings us to our final question, the one for you to think about. As you look at the world ahead, which of these two powerful stories is going to be the dominant force? Will it be the timeless, safe haven demand for gold driven by all the monetary uncertainty out there? Or will it be the explosive, can't live without it, industrial demand for silver driven by the biggest technological revolutions of our time? The answer to that question could very well define the next chapter for your portfolio.